Hello and welcome to this special series brought to you by Bombay Stock Exchange Investor Protection Fund and the Money Mile. Joining me today is one of India's best known financial planners, Shweta Jain. Thank you very much, Shweta. It's always a pleasure talking to you. Shweta, during these difficult times, the last few months, one of the issues that really came to the fore, and it's something that you've been talking for a very long time, is asset allocation. We saw a sharp fall in the equity markets, and at the same time we saw accidents even on the debt side of it, and that made people wonder that putting all your eggs in one basket really doesn't make sense. So can you tell us a little about what is asset allocation and how can an investor achieve that?
So asset allocation is dividing your money into various different investment options so that come what may, you are prepared and you are not hurt. So that is the basic premise of asset allocation. One of the things that we as investors forget is that all the assets in your portfolio should not move in the same direction. So in fact, I've seen a lot of investors that when they see equity going down, they want to cut down more equity, or when they see debt going down, they want to cut it down, or both of them are going down like we saw recently. Ideally, an asset allocation is appropriate or is done well when the assets in your portfolio are moving sort of in different directions. So when we saw equity fall, if you had say gold in your portfolio to diversify as well, you would have seen gold shoot up. So that means that it's a well diversified portfolio. Of course, debt had taken a hit for a short term period and still sort of recovering from that. But it isn't something that like I keep saying in my chats as well, right? That asset allocation is something that you need to make sure that you're on top of it. You can't just fill it, shut it, forget it. You have to balance it. You have to keep an eye on it. One of the things that is really important is an emergency fund. So for people who actually had emergency funds for 3 to 6 months, we're sort of okay, because even the debt part where we keep this emergency fund parked is short term and liquid. It's not where you're taking risk. And the debt funds that actually saw a lot of up and down, a lot of volatility, was the longer duration debt, more corporate debt than others. In fact, GSEC funds did quite well. So these sort of mixes will give you a good night's sleep at the end of the day. While March equities did fall, but it did recover in the last couple of months. So for people who sort of just hung on and did not tamper with their asset allocation, if anything, added in March. I know a lot of people who, unlike others, when they panic, did invest in equities in March, even if it was smaller amounts. For us, we have like an action bias, right? So we need to do something when market falls. So instead of booking losses, which we tend to do, we encouraged people to invest monies, even if it was smaller amounts. We said, do one SIP extra, for example, and that sort of gave them that confidence that they needed. And today, like, okay, even if it's a small amount and it didn't make a big impact on the portfolio, it's just a feel good factor. So I think asset allocation helps you stay in focus, helps you stay protected. It's that cushion which gives you comfort, which is what we need from our investment sometimes as well.
Thank you very much, Shweta, for joining me here on the Money Mile and sharing your thoughts on this very important series where we seek to educate investors about how they can go about their investing behavior. Thank you very much.
Thank you, Vivek.